Hello! Today I'm making a video on the last few units of flashcards that I hadn't already done for the CMA exam part 2. So let's begin. Starting with unit 13, the capital budgeting process. There's 6 steps. First one, we estimate after-tax incremental operating cash flows. Step 2, calculate the NPV of the investment. Step 3, make the financing decision, then evaluate financing alternatives, then implement the investment, and then finally monitor the investment. So the acronym to help me remember the capital budgeting process is ECMEM, ECMEIM, but really it's kind of ESC-MEM, because I want to remember that estimate is the E that's first rather than evaluate. And for the capital budgeting process, we want to use cash and incremental costs, not accounting income. Now, the post-audit in the capital budgeting process, its purpose is to provide feedback on the actual results. It formally compares the actual costs and revenues to the original estimates. It also exerts discipline in investment planning and control process, because if management knows that a post-audit will be implemented, they'll probably take more care in making those original estimates and assumptions in the first place, and thus better investment decisions will probably be made in the process. Real options. These are options to modify the capital investment, and they're not as easily measurable as financial options. Some types of real options are abandonment, delay, expansion, or scale back. Hurdle rate. It's the minimum rate of return on a project or investment an investor is willing to accept. When comparing mutually exclusive projects with different cash inflow patterns, the higher the hurdle rate, the more quickly a project must pay off. Depreciation tax shield. This is calculated by multiplying depreciation expense by the tax rate percentage. Net cash outflow in a capital budgeting decision. It equals the investment purchase plus the investment shipping, installation, testing, plus the working capital investment, minus the revenue of sale of old investment, minus the tax savings if the sale of old investment was a loss, which then those savings would be that loss, times 1 minus the tax rate percentage. Sorry. Just the loss times the tax rate percentage. Net cash inflow in capital budgeting decision relevant to the disposal of old equipment or old investment. That's the proceeds from the disposal plus the tax benefit from loss, which is the loss times the tax rate percentage, or you subtract the taxes on the gain, which is the gain times the tax rate percentage. Total after-tax outflows in year 0. First step. Net cash outflow equals the investment purchase plus the investment shipping, installation, and testing plus the working capital investment increase. Step 2, you calculate the tax benefit on the disposal loss or tax loss on disposal. And that equals the salvage value minus the current book value times the tax rate percentage. So that salvage value minus current book value is known as the accrual basis loss benefit on disposal. So you multiply that accrual basis loss or benefit on the disposal by the tax rate. And the final step to figure out the total after-tax outflows in year 0 are negative proceeds from the sale of old equipment minus the tax benefit on disposal loss or tax loss on disposal benefit, plus the net cash outflow. The traditional undiscounted payback period formula, and we do this when cash flows are constant, equals initial net investment divided by annual expected cash flow. The undiscounted or traditional payback period formula does not acknowledge the time value of money. Now, the discounted payback period formula, also known as break-even time or BET, it's the period required for discounted cumulative cash inflows on a project to equal the discounted cumulative cash outflows, i.e. the initial cost. Here, for the break-even time or discounted payback period, the period will begin at the start of the project, i.e. year 1, not when the initial cash outflow occurs, which was year 0. Desired rate of return. First step, you need to find the factor for the annuity table, and you find that by taking investment cost divided by annual cash flow. Then, for X number of years that they tell you, you find where the factor is on that row in the table for the year, and see what column, i.e. the percent, is for that desired rate of return. Annual net cash flow for years 1 through X minus 1. So the first year through the year before the last one. First step, calculate earnings before taxes. That's revenue minus variable expenses minus fixed expenses minus depreciation expense. Then you calculate net income, so you take those earnings before taxes times 1 minus the tax rate. The annual net cash flow then is that net income plus the depreciation expense, since depreciation is not a cash flow. And remember, for the annual net cash flow, you don't want to discount it. Annual net cash flow for that last year of the capital investment. So you do those same steps, and so you find that total net cash flow for that last year by taking the net income and adding back depreciation expense, but you're also adding back the working capital investment from year 0 because it comes back to you on the last year. End of life cash flows. First step, taxable loss equals negative tax basis minus disposal expense plus the inflow from the sale or the salvage value. Tax savings then is that taxable loss times the tax rate percentage. Working capital recovered is the working capital investment times the factor from the single dollar table. And finally, for final cash flows, you take negative cost to remove or dispose plus that inflow or the scrap plus the tax savings from the taxable loss and the discounted working capital recovered. Ordinary annuity versus annuity due. Ordinary annuity is a series of payments at the end of each period. So the first payment will be discounted because it occurs at the end of the first period, which is normally a year. An annuity due is a series of payments occurring at the beginning of each period. So that first payment will not be discounted because it's occurring like right at the start of the whole investment. NPV, net present value. So for the initial investment, that's the initial investment in the equipment or whatever, plus the working capital increased investment. And you're not going to multiply it by a factor because it happened in the present. It happened here in year 0. And then annual cash flows, we talked about it earlier, and you just have to remember that for the cash flows from year 1 to the year before the last year, you use a factor from the annuity table. And the cash flows for end of life, so the last year, you use the factor from the dollar table. The net present value of outsourcing. First step is the after-tax annual cost of outsourcing. And the second step is you take the after-tax annual cost of outsourcing and you multiply it by the present value factor from the annuity table. And that equals net present value. IRR, internal rate of return. It's the discount rate where net present value equals 0. It incorporates the time value of money, by determining the compound interest rate of an investment such that the present value of the after-tax flows over the investment life equals the initial investment. Factors that reduce IRR usefulness. First of those is the direction of cash flows changes between periods. Another one is when you're considering mutually exclusive projects. Another one is there are varying desired rate of returns for different periods. And the last one is if there are multiple investments, because the IRR for the whole does not equal the sum of each part's IRR. If net present value is greater than 0, then the project's rate of return is greater than the hurdle rate. If net present value is less than 0, the project's rate of return is less than the hurdle rate. And if net present value equals 0, then you found the IRR. Remember, IRR is the discount rate where NPV equals 0. Profitability index. It's the method for ranking projects such that resources are used on the highest discounted future net cash flow per dollar invested. And that's calculated by taking the present value future cash flows divided by net investment. And that numerator could be either the investment cost plus NPV or just all future net cash inflows without the initial investment. If the profitability index is greater than 1, we want to accept the project in general. If it's less than 1, we probably want to reject it. Accept versus reject revisited from a different video. We want to accept a project when the NPV is positive, or we want to accept the project with the highest positive NPV if they're all mutually exclusive. You want to accept when the IRR is greater than the hurdle rate. You also want to accept when the profitability index is greater than 1. You want to reject when the NPV is negative, and also if the abandonment value of the project is greater than the net present value of the project. You want to reject when the IRR is less than the hurdle rate, or if the profitability index is less than 1. Now on to Unit 14. IMA overarching ethical principles. These are honesty, fairness, objectivity, and responsibility. My acronym to remember this is IMA overarching ethical principles are FRO. FRO, fairness, responsibility, objectivity, honesty. Now the 4 IMA standards, my acronym for this is either IC or SICK. I'm still kind of deciding on that. But in any case, the 4 IMA standards are integrity, competence, confidentiality, and credibility. Integrity is one's own internal compass. Competence is you perform the job well, or as to the best of your ability, and you also keep up on CPEs. Confidentiality is you keep quiet unless you're authorized or legally required. Credibility, you communicate timely, fairly, and objectively. Fiduciary responsibility, you act solely in another's interest. Fraudulent financial reporting versus misappropriation of assets. Fraudulent financial reporting, the goal is to deceive financial statement users, and thus fraudulent financial reporting is most of the time committed by management. And this is the main focus of external auditors and regulatory bodies to prevent and detect. Now, misappropriation of assets normally presents as theft, embezzlement, or defalcation, and it's mostly committed by employees rather than management. Fraud triangle. It consists of opportunity, pressure, and rationalization. Now, opportunity, remember, is the only characteristic that's controllable by management. And the difference between rationalization and pressure is rationalization is the ability to justify actions as consistent with your personal code of ethics, but the pressure is the why, as in like, I don't know, I feel broke, or I have a gambling addiction, or I feel like people at work don't treat me well, so I'm getting my just desserts. That's the pressure. Purpose of anti-bribery laws. There's 3 purposes. Those are to prevent illegal practices, or create a level playing field in international trade, and increase quality of internal controls. The top 2 anti-bribery regimes in the world. The first one, FCPA, the U.S. Foreign Corrupt Practices Act, has 2 provisions: anti-bribery, which makes corrupt payments to foreign officials illegal, and the accounting side, which has kind of 2 sections within it. You have to keep accurate and timely books, records, and accounts for financial reporting, and you also need to devise and maintain a system of internal control. The UKBA, UK Bribery Act. There's 4 offenses. You offer a promise or give an advantage. You request, agree, or accept an advantage. Bribery of foreign public officials, or failure to prevent a bribe. This anti-bribery law is the highest impact worldwide because it's strict in punishment and broadly applicable. Because, if you give a bribe or potentially receive a bribe, or even just fail to prevent one, you're affected. Sarbanes-Oxley Act, SOX, requires U.S. firms registered with the SCE to have a whistleblowing framework or hotline. Organizational culture. It's the values, beliefs, norms of employees within a firm. And finally, for end of Unit 15, the 4 levels of the corporate social responsibility, CSR: economic responsibilities, legal responsibilities, ethical responsibilities, and philanthropic responsibilities. My acronym for corporate social responsibility is ELELP. Kind of like help, but not. And that's it. Thank you.